Welcome. The labor market takes a jolt as we dive headfirst into Jobs Week. Welcome everybody to SRT Live. I am your host, Sean, with the Sean Richard Mortgage team here at Guaranteed Rate. Hope you're having an incredible week so far. And we've got a big week ahead of us, a lot of economic news and data, housing information. So we're going to dive right in. Let's start, as we always do, with the week in review. So last week, we got a slew of economic and housing data. One of the more important notes that we got last week was PCE, which is an inflation report, personal consumption expenditure. Now, what's important about this report is this is the Fed's favorite measure of inflation. The Fed is looking at core PCE on a year-over-year basis as their target to get that down to 2%. So PCE last week came in month over month at a 10% increase. And this was versus an expectation of 0.3%. So this was a big win for inflation or for the economy in the fight against inflation, as it came in 0.2 lower than expected and also 0.2 lower than the month previous back in February. Back in March. Year over year, inflation came in at 4.2%. And again, a great win. This is down from 4.6% on the expectation and 5.1% as of March. So pretty significant decline in year over year inflation with the readings that we got last week. So really, really good news. Now, and remember, inflation is very much the enemy of mortgage rates. So as we see inflation decline, we will start to see mortgage rates decline as well. So if you're a home buyer waiting to jump into the market for rates to decline, we're heading that direction, but we've got another piece of the puzzle that is about to start ticking up again, and that's home prices. And so go back, watch last week's episode if you have questions about that, but really important movement in inflation. We also got consumer sentiment from the University of Michigan, and this is really a gauge on how the nation is feeling about the direction or the state of our economy. And this is on a sliding scale. So this came in across the board at 63.5% on this index. So that means the reading was 63.5, the expectation was 63.5, and the previous reading was 63.5 as well. Now, this is quite low, and it really just tells the story that as a nation, we're not really sure. The markets, the economy has been very volatile lately, and we're just kind of like, we think we're moving in the right direction, but we're not hyper confident in that. And so that's really what this reflects down in that low to mid 60s level on this index. Now, last Thursday, as always, we got jobless claims. This is initial and continuing unemployment claims. Initial being individuals filing unemployment for the first time, and continuing would be those individuals renewing their unemployment benefits. So last week, we actually saw a decline in week over week unemployment claims down at 230,000. This is in contrast to the week before, where we got 248,000 new claims. Now, ultimately, this is still elevated from the sub $200,000 level or 200,000 level that we saw over the past several months. But this is very much an area that we want to keep an eye on. Continuing claims also didn't really see a drop of any significant nature. Last week's report, or the week before, came in at 1.86 million. And this week's report, or I guess last Thursday's report, came in just a hair below that, 1.858 million. So not a whole lot of change in the continuing claims. Now, remember, when it comes to the labor market and how tight or soft that it is, you've got the sequence of events. And I talked about this last week, where employers, they're going to start, they're hiring people. And when the economy starts to downturn, they're not just going to fire the people, start firing people left and right. First thing that's going to happen is they're going to slow the pace or freeze their hiring which is going to be reflected in some additional reports. The second thing that they're going to do is they're going to reduce the hours that people are working, mainly their hourly employees throughout the company. And then if that's still not enough to help correct for the economic conditions, then they'll start to lay people off. So the jobless claims is really the last shoe to drop when it comes to where the labor market is. And we'll get into one of the earlier shoes to drop in just a moment. We also last week got the first reading of Q1 GDP, and this came in well below expectations. If you recall, Q4 GDP came in at growth rate of 2.6%. Q1 was expected to come in at 2%, but came in all the way down at 1.1%. So growth in our economy on the slow pace to start the year. We've got two more readings, once in May and once in June, to see where we end up with Q1 GDP. So we'll keep an eye on that. And then from a real estate perspective, we also got pending home sales. This is signed contracts on existing single family homes. And this came in well below expectations. Expectation is that we were going to see 0.5% month over month growth. This was based on or off of last month's reading of flat, 0%. We actually came in down 5.2% month over month on pending home sales. Now, part of this could be a reduction in demand, and part of it is most likely tied to lack of inventory. And I've talked about inventory substantially over the past several months. Going to touch on it again a little bit later today, but inventory is definitely a problem, but a combination of those events are hindering pending home sales. Now, jumping to this week, we've got two critical reports that we got so far this week. The biggest and boldest of those is going to be the JOLTS report that we got today. Now, the JOLTS report measures job openings across the country. The importance of this goes back to the sequence that I talked about just a few moments ago, in that we start to see the labor market softening when employers slow down or freeze their hiring. So job openings play a critical role in that sequence of events. And the JOLTS report did not disappoint. JOLTS report came in quite a bit below expectations. Market analysts were expecting around 9.8 million job openings. Came in all the way down at 9.59 million. So we saw a couple 100,000 job openings below expectations. And this was significantly below last month's reading of 9.97 million. So we're seeing job openings slow down, very much an indicator of the labor market softening, which has been a key focus of the Fed. And that's really an important component that we want to keep an eye on going forward. Now, jumping ahead this week, tomorrow we've got the ADP payroll report. This is a great precursor to the BLS, or Board of Labor and Statistics, jobs report that we get on Friday. We also get the Fed rate decision. The Fed started their 2-day meeting today. They're going to wrap that up tomorrow, and we're expecting a 0.25% increase to the Fed funds rate. Full disclaimer, the Fed funds rate does not directly impact mortgage rates, so don't worry about that. And then after the Fed meeting tomorrow, we're going to hear from America's favorite Fed Chair, Jerome Powell, affectionately known as J. Powell. His comments are going to be pretty important, and I'll touch on that here in a moment. Thursday, as always, we get our jobless claims. We're going to be watching the trending direction of that. We get the ECB rate decision as well, which is the European Central Bank, essentially the equivalent of our Fed. And then on Friday, we get that massive Board of Labor and Statistics jobs report. We also get the unemployment rate. And then equally as important, we get hourly earnings and weekly hours. And I haven't focused as much on these two pieces of that unemployment puzzle in the past, but with that sequence of events that I've been talking about over the last couple of weeks, these two components, hourly earnings and weekly hours, play a bigger role, or really are more in focus than they have been in the past. So that's what we have to look forward to this week. So the next question is, what am I focused on this week and over the next week as we try to understand and navigate our economic and real estate markets? Number one, of course, this week is the Fed meeting. We are expecting a 25 basis point or 0.25% rate hike. Now, the good news is that's already been baked into everything. The market analysts are expecting that. The markets have already accounted for it. Unless the Fed pivots and does something different, there's no need to panic, and that's not going to have any significant impact on the markets. However, what is more important is the statements made by Jerome Powell in his press conference tomorrow. He'll have his prepared remarks and what he says about the direction of inflation, what the Fed plans to do about it, how data dependent they are, as well as I expect he'll comment on the recent failure or buyout of First Republic Bank. That all is going to play a role in where the market's head. So Jerome Powell's comments tomorrow are going to be an impactful component of where the markets move later in the afternoon. We're going to hear Jerome Powell speak tomorrow just after lunch. And then the other piece of the puzzle that I'm focused on is the First Republic Bank buyout. Essentially, they failed. I believe JP Morgan stepped in and worked out a deal to purchase them. But this is a big deal. This is evidence that there's still instability in the banking sector. And the market doesn't like this. The market likes certainty, and instability in any sector is going to cause uncertainty. And being that it's the financial sector, it really puts an even bigger impact on that. Now, what this also indicates is this failure and continued instability in the banking sector may result in continued tightening of the credit markets by the banking sector. And this would most likely lead to the Fed halting or taking their foot off the gas of their rate hikes. Ultimately, the reason the Fed is increasing the Fed funds rate is to tighten credit conditions and kind of destroy, harsh word, but destroy demand. So tightening by the banking sector would take the place of the Fed needing to do as much on their end with their monetary policy. And so that may also allow the Fed to calm down or take their foot off the gas of their tightening policies. But the bottom line is there is still uncertainty in the economy right now, and that's having a pretty significant impact across the board. So looking forward to hearing what Jerome Powell says tomorrow. Pay attention to that. Pay attention to the Board of Labor and Statistics jobs report on Friday, both critical components that are going to let us know what the markets are going to be doing heading forward. As of today, the lower JOLTS report we got is helping look great. I'm going to go ahead and share a little bit of information with you real quick. We're having a great day in the mortgage markets. Pricing is improving from where we were yesterday. Let's see. Let me share this with you real quick. Check this out. There we go. All right. We've got mortgage-backed securities up 41 basis points. You don't have to know a whole lot. All you need to know is that when mortgage-backed securities or MBS are up, that means interest rates, mortgage rates are on their way down. So we're having a great day in the market today. The question remains as will we be able to continue that trend? The markets have been quite volatile. And you can see this chart of mortgage-backed securities up and down, up and down, up and down across the board. So a lot of volatility, but we love when we have a really good day like this. So awesome stuff. And can't wait to see where we head after the Fed meeting tomorrow. Gang, that's all I've got for you today. I want to say a big thank you for joining me on this episode of SRT Live. If you are checking us out on the Powerhouse Facebook private group, make sure that you leave comments or questions down below. You can also reach out to me at the phone number here. And I want to say a big thank you for being an amazing part of our community. If you're watching on the YouTube channel, make sure to hit that subscribe button so that way you can stay up to date on economic, real estate, and mortgage information throughout the week and have better conversations with your clients as a real estate agent, or if you're a home buyer or seller, so you can stay more in tune with what's going on in the real estate market to help you make better decisions. Again, Sean with the Sean Richard Mortgage team, thank you so much for joining me. Have an incredible rest of your week.